Doctor, I think we can start once we have up to 150 participants.
Okay, Steve, if you know one
We have
to
less than
start,
100 participants. Maybe you can start.
or should I wait? Or
Yeah, do we
I
give
think the
them
normal, huh?
do we give more minutes to allow more participants to log in?
Like how many
Or
minutes?
while I read your profile, at least we may have we have up to 100. I think we can start.
Okay, you have the discretion, the ball is on your court, so whatever you tell us to do, we'll do it. You are the boss.
Thank you very much, wonderful participants. Today, our facilitator for today is Jude Odinkonibo, and he's going to take us through the topic digital taxation in Nigeria and the implications of the OECD's G20 proposal. So I'm going to briefly read the citation for our participant before he takes us through the lecture. So Jude is a counsel at Templars and one of the leaders in the firm's compliance investigation and white-collar defense, dispute resolution, and tax practice groups. He holds a PhD in taxation law and policy from Osgood Hall Law School, York University, Canada. He's an alumnus of the Yale Law School, Yale University, United States of America, where he obtained his LLM in international taxation law. He also holds another LLM in intellectual property law from the Schulich School of Law, Dalhousie University, Canada. Jude has over 20 years experience in litigation and arbitration, tax advisory, and corporate and commercial law. He has significant industry experience advising local and international clients on a broad range of matters, including litigation, compliance, regulatory issues, corporate restructuring and reorganization, domestic and cross-border mergers and acquisition, as well as transfer pricing. As an academic, Jude serves as a senior lecturer at the Faculty of Law, the University of Nigeria, where he teaches different aspects of Nigerian tax laws and international taxation. He has published widely in the area of taxation law and policy and other commercial law subjects impacting on the Nigerian economy. Jude is a member of MBA Board of Institute of Continuing Legal Education and the Dean of the Tax Faculty of the Institute. He's also the chairman of the Continuing Legal Education Committee of the Enugu branch of the Nigerian Bar Association. He's recognized as a notable practitioner in the IFLR 1000 guide to the world's leading financial and corporate law firm. Ladies and gentlemen, please welcome our facilitator for today. And as you can see from his profile, we are actually in the right hand on this very important and contemporary issue in taxation. Welcome, Dr. Jude.
Yeah, thank you, Chibike. I just think, I don't know, Sarah, can you share the slides? Will you be able to, I want the slide to be shared. So you can,
yes, sir, we'll share it now.
Okay. Thank you everybody, and thank you all the participants. The topic of today has already been, as mentioned by Steve. The title is Digital Taxation in Nigeria and the Implications of the OECD G20 Proposals. So this very topic, as we can see, I just want to give you the summary. The point is that generally in international tax law, the basis or the nexus for taxation is always tied to fiscal presence, or what you may call in international tax, permanent establishment, and which, if we bring it back down here, you say, well, whether a company has a fixed base. However, what we're going to see here mainly is the interplay of international politics. You know, there's the contending forces between the developed countries and mainly United States of America, or the home base of multinational companies, and Nigeria and other developing countries, Nigeria in particular. So I want to start. Sarah, can you move to go to the second page? Can you go to the second page? I guess, is this the second page? This, okay, no, the second page, yes. Move to the next page. Okay, for me, I can actually go ahead with this, whether you are showing the slide or not. The point is that the question you ask is, what is digital taxation? What do you understand by the term digital tax? The point is that our tax system, as I have said earlier, actually is based on fiscal connection and fiscal contact. So, but currently, we have seen the role internet technology has played, to the extent that you could be in Nigeria here and you'll be interacting with somebody elsewhere. Companies located in the United States, companies located anywhere in the world can do business in Nigeria. We can reach our people. So that digital space, the virtual space, as far as tax is concerned, is ungoverned. And the international tax rule, under the international tax rule, the principle for taxation is based on permanent establishment. So you ask yourself, what actually is this permanent establishment? What does it mean? Well, there are two models. You have the OECD model under Article 5. You have the United Nations model under Article 5. They all define what permanent establishment is all about. So we may have to, if you have time, I'm not going to go into detailing what these permanent establishment under the rules are. But if you have your time, you can check Article 5 of the OECD or the Article 5 of the United Nations Convention, Tax Model Convention. So these particular models, the articles, Article 5, they all talked about a company that for a non-resident company or multinational company to be taxed in any location, there must be that it must have fiscal presence in that country. So the concept of permanent establishment is mainly used in most bilateral treaties to determine the right of a state to tax the profit of an enterprise of the other state. So for a state to exercise a right under the extant international rules, tax rules, that state needs to show that the company that you want to tax or the enterprise you want to tax has permanent establishment. And this permanent establishment is the term that is used in most bilateral treaties to confer taxing rights to a particular state or tax the profit of an enterprise in the other state. So in particular, the profits of an enterprise of one state are taxable in the other state only if the enterprise maintains a permanent establishment in the latter state, and only to the extent that the profits are attributable to the permanent establishment. So you have to show that the enterprise has a permanent establishment and that the profit you want to tax is attributable to that permanent establishment in your locality. So both the OECD and United Nations Model Tax Convention require a company and enterprise to have permanent establishment, what we call PE, in a jurisdiction before it could be liable to tax in that other country. So the concept of PE is witnessed in virtually all existing double tax agreements, DTT. For instance, you can, as I said earlier, you look at Article 5 of both the Nigeria UK DTT, Nigeria South Africa DTT. So the same principle applies to all DTTs. So now, if you go to the OECD Tax Model Convention and look at Article 5, it appears similar with the one you have in Article 5 of the United Nations Convention. For instance, if a company has a fixed base in your country or has a contact, a connection. So I don't know if I can pull out the OECD Convention, Tax Model Convention to read out what you have in Article 5. So that I won't read everything because it's so huge. Just to have an idea of what Article 5 is saying. So Article 5 of the OECD states that for the purpose of this convention, the term permanent establishment means a fixed place of business, through which the business of an enterprise is wholly or partly carried out. Under paragraph 3 says that the term permanent establishment includes especially a place of management, a branch, office, a factory, a mine, an oil and gas well, quarry, or any other place of extraction of natural resources. A building site or construction or instruction project constitute permanent establishments only if it lasts more than 12 months. So one of the differences you are going to see between the United Nations Convention and that of the OECD Convention is the period. The OECD Convention has 12 months. The United Nations Convention has 6 months for building site, construction, installation of projects, and the rest. So then you will see some exemptions. It's notwithstanding the preceding article, the permanent establishment shall be deemed not to include the use of facilities solely for purpose of storage, display, delivery of goods, merchandise belonging to enterprises. So you have a long list of exemptions. And it appears if you look at section 13, subsection 2, 3 of the CETA, if you have an office in Nigeria here for purpose of detaining storage and all that, then definitely, or for display, it will not qualify as a fixed base. And companies in Nigeria, for instance, companies in Nigeria have in the past exploited this loophole. If you read the case of Federal Board of Internal Revenue and Shell Masterbish, it was one of the arguments presented by the Shell, the Anglo-Saxon company based in Netherlands, using the office of the Shell Nigeria. They were saying, oh no, that we just came, we are using this place for collection of information and materials and all that. Although the court ruled against them without defining what fixed base means. So but we're going to see some other cases here that where the court eventually gave a flesh and giving meaning to what permanent establishment is all about. So you now see the permanent establishment as under the OECD rule, OECD Model Tax Convention, and that of United Nations Model Tax Convention are similar. The United Nations Model Tax Convention are actually based on the OECD, but it appears to, for instance, a number of months, reducing 12 to 6 months, and just it appears to, if one may argue that it's pro-developing country. Because if you look at OECD, definitely members of OECD are mainly developed countries, even though now they're admitting some of our colleagues as participants, not really members anyways. So under the Nigerian domestic tax law, what appears similar to permanent establishment is the term fixed base. So the term fixed base under our law mimics the word permanent establishment, and you'll find this under section 13(2)(a) of the company's income tax in Nigeria. So section 13(2)(a), as we all know, this was one of the sections that was kind of amended by section 4 of the Finance Act 2019. But for the purpose of fixed base, section 13(2)(a) of the CETA imposes tax on the profit of non-resident companies. NRC, non-resident companies are mainly foreign companies or companies that are not registered under our law, that's not registered with the CAC. So a non-resident company is a company that's not, it doesn't have office here, it does not have headquarters, or perhaps, a branch office or where it conducts business here. So it comes in to do one or two things here. So, and one could say that it's actually a foreign company. So now, section 13(2)(a) says that a non-resident company or a foreign company that has a fixed base of business in Nigeria is taxable to the extent that the profit that is going to be taxed is attributable to the fixed base. So if a foreign company has a fixed base in Nigeria, the earnings of that foreign company, as long as it is attributable to the profit derived by that fixed base, is taxable in Nigeria. So prior to the amendment made by the Finance Act 2019, tax liabilities of foreign companies or non-resident companies are triggered by 4 rules, namely possession of a fixed base in Nigeria, to which relevant profits are attributable to, having a dependent agent in Nigeria authorized to conduct business on its behalf, turnkey contract, like, okay, an award, a contract is given to a foreign company in Nigeria, come and build this house or build this company for me. At the end of the day, once you finish, you hand over. That's turnkey contract and we'll pay you. So whatever money derived in doing that is taxable in Nigeria. The next one is related party transactions deemed to be artificial or fictitious. So when you have related party transactions, of course, the issue of transfer pricing was discussed here, and there's some dealings between them. Under the section 13(2)(a), one can say, hey, anyway, you are based in United States, but you have a related party here that you either control or controls you, and there are some transactions conducted, you can tax it. It's one of the anti-avoidance provisions under our law. So now, digital tax. What is it? I think I've explained this earlier. The digital tax relates to the tax that imposes tax on the income of companies or enterprises that derive revenues through our digital space or virtual space. So the term fixed base is not actually defined under any of the tax statutes in Nigeria. I mentioned the case of Federal Board of Internal Revenue and Shell Master Beach, where they Shell, based in Netherlands headquarters, they sent officers to come down to Nigeria here and occupy the office of Nigerian Shell, collecting information as they claimed and all that. And yet they have a different billing method through which they settle themselves. It was held in Nigeria that that amounted to fixed base without defining that. However, the meaning of the term has been given a flesh by our courts and or tribunals in the cases of JGC Corporation and FIRS, and that's Petroleum and FIRS, where it was held that a place of resort that is available to a company for the purpose of its business qualifies as a fixed base for the purpose of taxation. So whenever a company, if you have an office in Nigeria, whether you are using the office of your subsidiary here, and that place is one say that you operate from that place, that could give you the cloth of that fixed base in order to be subjected to the Nigerian tax laws. Now, the advent of internet has given rise to the possibility of generation of income. I've said that the advent of internet and technology has given rise to the generation of income from countries that are thousands miles away from where the company or enterprise has permanent establishment or where the profit is managed. The same thing can as well be brought back to even in Nigeria here, even though our concern currently now is based mainly on cross-border transactions. We haven't looked into our domestic laws to ask ourselves questions. Because, for instance, you have Konga, or any of those companies that distribute goods. You also have, or even you could have a company here based in Lagos here. If you're an individual, for instance, for companies anyway, we could not make a case for that because FIRS collect taxes from all companies. Let's assume individuals or enterprises, and you market your goods, you sell, you have, somebody can order goods, and you just deliver from one state to another without having physical presence there. Or, I don't know. So you can just imagine the possibility of a company resident in Lagos that delivering services or whatever in other states, or an individual. And for the case of individual, considering that State Board of Internal Revenue collect taxes from individuals resident in their state, do you think that some of these controversies we've seen in international taxation could be brought back home here? So that's a possibility. Now, because of the erosion, because if you look at action 1 of the base erosion and profit shifting actions that the OECD has developed to use it to, combat problems of base erosion from digital, activities. The company will now resort on using this, knowing full well that, well, I don't have presence. So following the current international tax rules, I can't pay tax. I'm not subject to your country's tax. So please, can you move to, okay, I think I'd seen that page 2. Is it page 3? I've passed page 3. You move to page 4. Move to page 4 so they can they'll be able to see what I have. Page 4. Okay. So the point now is that most countries, including Nigeria, you have Nigeria, France, India, and other countries, are now taking unilateral decisions on their own. Because I'll give you the background. When Trump was there as a president of the United States, he was against entering into any multilateral agreement to address this issue, addressing the issue of digital taxation, because most of the multinational companies are actually American-based companies. You have Facebook here, Netflix, you have X or Twitter, and all that. They're making money from Nigeria. Possibly they may not even have office here. And people are using these companies to advertise their products, pay. So Nigeria felt that, you know what, we have to tax these digital activities because there is erosion. There's a base erosion. Base erosion meaning if I don't tax certain activities or allow it on tax, you are eroding my base. You are collecting income from my jurisdiction without being taxed. That's what it means. So, as I say, that OECD, one of the problems that one of the solutions the OECD has mapped out is the Action 1 plan to combat digital issues arising from digital activities. So how do we tax companies that earn income from jurisdictions they don't have fiscal presence? So when Trump was there was no agreement. They said that, oh, we're not going to agree. France was threatening. Some countries in the European Union were threatening. Trump said, if you tax the income activities or incomes earned by multinationals, US-based multinationals, we are going to impose tariffs. We are going to, more like a trade war. Everybody here, of course, you know what happened during Trump regime, United States and China were imposing tariffs and all that. And that's going to frustrate international trade. But then you cannot allow your own jurisdiction to be eroded. Twitter is doing business in Nigeria and probably may not have office. Facebook is doing business in Nigeria and probably may not have office. The same thing with Netflix. So we just stay because the internet and technology has made it possible that these people will do this, unlike before. So there's a shift in the way we do things currently. Of course, now I'm in my office giving lectures. You are probably in your own office. This was not possible before. Before, everybody will have to come into a particular physical space. You'll be seeing me, I'll be seeing you, I'll be delivering lectures. So you can see that normally services are being rendered, and possibly these services could be paid. We're going to see what Section 4 of the Finance Act 2019 did in imposing taxes on such activities, online activities, or when you give, when there's a professional services rendered through online and you are paid for it, you need to pay tax. So what we say that those areas that these companies derive income without having physical presence could be said to be the market. That's the market jurisdiction. You call them the market jurisdiction. So what will the market jurisdiction do? Will the market jurisdiction fold its arms and say, I will not tax? So in 2000, and can you move where I am now? So yes. Okay, let's go to page 5. Move to page 5. Page 5. Can you scroll up to page 5? In page 5, I have the overview of Nigerian digital tax, the significant economic presence in Nigeria. That's where you should go. So that, hello? You are no longer showing, okay. The screen is not showing. Go to page 5. So under here, under 5 is to say overview of Nigerian digital tax, significant economic presence in Nigeria. The Finance Act, as we say that the Finance Act made some changes. It made some changes relating to taxation of digital activities. So the Finance Act imposes income on activities, digital activities of companies or non-resident companies that have what you call significant economic presence in Nigeria. When you have the significant economic presence. So even though the term significant economic presence was not defined under Section 4 of the Finance Act that amended Section 13.2 of the CETA, it gave the minister the power to promulgate a regulation or an order defining that, and the minister did just that by the promulgation of the Companies Income Tax Significant Economic Presence Order of 2020. So, and that order, if you can pull out the order to look out and see what the order says about meeting the significant economic presence test. So it says that foreign companies involved in digital activities have significant economic presence if they fall under any of these categories. If the foreign company derives gross turnover or income of more than 25 million naira or its equivalence in any currency. So as long as that company or the non-resident company derives its gross turnover or income of more than 25 million naira or its equivalent in any other currency, that is the starting point. You have to meet the financial threshold. When the financial threshold is met, now there are other things that will give you the plot of significant economic presence, streaming or downloading services of digital content, transmission of data collected about Nigerian users generated from users' digital activity, provision of goods and services directly or indirectly through a digital platform, provision of intermediation services through digital platform that links suppliers and customers in Nigeria. If the foreign company uses a Nigerian domain name, NG, or registers a website address in Nigeria, if the foreign company has a purposeful and sustained interaction with persons in Nigeria by customizing a digital platform to target persons in Nigeria. So these will all meet the significant economic presence test. So now the next slide deals with technical, professional, management, and consultancy services. So can you show that? Can you move it up to the next page? Okay, yes, that's it. Technical and a foreign company with a trade or business relating to technical, professional, or consultancy services will have significant economic presence in Nigeria if it earns any income or receives payment from a person resident in Nigeria, a fixed base, or an agent of a foreign company. The order also clarifies that technical services relate to any service of specialized nature, including advertising services, training, or the provision of personnel. Notwithstanding the foregoing, a foreign company will not have SEP in relation to any of the payments made to an employee of a person making the payment, for teaching in relation to an educational institution by a foreign fixed base of a Nigerian company. So if a foreign company is making a payment to its employee, then it doesn't qualify. It will not meet up the threshold. Or foreign company is rendering a teaching services in an educational institution. I guess maybe to encourage the growth in our education. Maybe that's why they have it there. Or by a foreign fixed base of a Nigerian company. Nigeria has a foreign fixed base. There's a Nigerian company that's headquartered in Nigeria here that has a foreign fixed base in another country. Now, the order, however, states that any foreign company covered under a multilateral agreement or consensus arrangement to address tax challenges arising from digitalization of the economy, which includes Nigeria, will be treated according to such agreement. So what it says that if there is either bilateral or multilateral agreement that covers issues of digital taxation, that particular agreement should instead be used rather than the provisions of the order. So I don't think, can you move up to the next slide? Okay, now, having seen what Nigeria has done, what it means is that here, Nigeria does not have to wait for there to be multilateral agreements before it start taxing foreign activities of foreign companies or non-resident companies in Nigeria. So we have taken a unilateral step. And this I remember during Trump's regime, Trump actually threatened that anybody who taxes American company digitally for its digital earnings, that the US will impose sanctions or tariffs. There's going to be more of a trade war between the United States and that other country. Nigeria went ahead to do this regardless. So now, unfortunately anyway, around October 2021, I don't know whether you around October 2021, about 136 countries met to decide this issue of to have a tax deal. Let us have a tax deal and see how we are going to come up with a consensus, which every country has to adopt in taxing, imposing, in taxing income of non-resident companies or foreign enterprises in their respective countries. So we are going to see, we're moving now to, we're going to see the agreement or the statement which Nigeria says refuses to accede to. So move to the next slide. We have we did touch some of these things. I've dealt with this. So where are you? Can you go to the step where we started with the, okay, the OECD, global minimum tax. The OECD has been taking steps to address the challenges arising from digitalization of the economy. In October 2021, 136 countries, members of the OECD G20 inclusive framework, reached an agreement to address tax challenges arising from digitalization of the economy. And specifically, the agreement introduces the two-pillar solution we are going to look at. Can you scroll up? So there's a two-pillar solution. We have pillar one, pillar two. We're going to see what pillar one covers under amount A and amount B. Scroll up again. Okay. So the pillar one, in particular, the pillar one seeks to ensure a more equitable allocation of profits and taxing rights among countries by reallocating rights from the home countries of MNEs, multinational corporations, to market jurisdiction where they have business activities and earn profits. As we say that under the extant international tax rule, under our law, it says you need to have fiscal presence kind of in the other country before you can be taxed. So if a company is headquartered in America or headquartered in any country, for you to tax it in Nigeria here, there must have fiscal presence. And we have looked at the OECD model tax convention, the Article 5 of it, defining what permanent establishment is. Almost the same definition is what you have in the United Nations model tax convention under its own Article 5, only but little amendment, maybe relating to the number of months in relation to if you have a construction site that somebody has, a company has come to do some constructions or staying there in rendering certain services. The OECD rule is said you have to stay like up to 12 months. The United Nations is saying 6 months. You know, so all those, these are just similar, small variations. But the point is that all of them are talking about permanent establishment. And the requirement of that permanent establishment, you are not going to see that the threshold will not be met when a foreign company is driving income from your own country. So the essence of that meeting or the agreement in October 2021 was to shift, like adjusting the rule to move away from having that fiscal presence, but to consider the market jurisdictions where the income is earned by a company that does not have fiscal presence. So he says, as long as I'm still in that slide. Go back to that slide. So as long as you have you earn income from that particular market jurisdiction, you should pay tax. So this means that this will extend the tax nexus to virtual activities resulting to income earned from market jurisdiction. As I said, the strict and sole requirement of fiscal nexus has been watered down. Now move to the next slide. So now we're looking at amount A. Well, there is this under Pillar 1, it's actually say that if we apply this rule, that it is expected that more than 100 billion US dollars of profit will be reallocated to market jurisdiction each year. 100 billion, that's their claim. Anyway, so, and the question is whether this will benefit developing economies like our own. Then Pillar 1, under Pillar 1, you have what you call Amount A. You have Amount A, you have Amount B. We're going to see what each of these deals with. Amount A seeks to address the potential loss of tax revenue. Tax revenues are rising from digitalization of the global economy by recognizing the taxing rights of market jurisdictions, that is, where the goods and services are sold or where users are located, to tax companies deriving income from jurisdictions where they do not have fiscal presence. That's all it's saying. Move to the next slide. So now we are going to look at the threshold, the monetary threshold to meet this, to be able to be taxed digitally under the Pillar 1 Amount A. Then Pillar 1 Amount A applies only to multinationals with a global turnover. So you can now listen very well. This is the more interesting part. I think this is very interesting part. You see why Nigeria has said, oh, we are not going to sign or accede to the statement or the agreement. Because if we look at this, it's not going to be favorable to us. So the Pillar 1 says Amount A applies only to, of course, large multinationals that make huge profit. So he said Pillar 1 Amount A applies only to MNEs, multinational enterprises with a global turnover of 20 billion euros. So the minimum will be that the multinational must make over 20 billion euros. It doesn't stop there. And 10% profitability. 10% profitability, if 10% of 20 billion will give you about 2 billion euros. So that company, the global profitability will be 10%, which is about 2 billion euros. And that company, it doesn't end there. It must derive at least 1 million euros in revenue from the market jurisdiction. Are you getting that? So it doesn't end that the multinational corporation will make over a global turnover of over 20 billion euros. It does not only end there, it must have a profitability of 10% profitability. Let's take that the minimum threshold, which is 20 billion. 10% of it is going to give you about 2 billion. It doesn't end there. That company must derive at least 1 million euros in revenue from your country before you can tax it. 1 million euros. Or at least 250,000 euros for small jurisdictions. The small jurisdictions are defined as jurisdictions that have less than $40 billion GDP. If your GDP is less than 40 billion, like for instance, a country A, if the GDP is less than 40 billion euros, then you can only tax if the MNE makes up to 250,000 euros in revenue from each jurisdiction. So Nigeria, as at 2022, our GDP was 477.39 billion US dollars. And we're projected to make about 491.1 USD by the end of 2023. So in any case, Nigeria is not considered as a small jurisdiction. So which means that the general rule will apply to us, that the global turnover of the MNE that want to tax must be over 20 billion euros. Not only that, it must make up to 100%, 10% profit globally Now, not now within Nigeria, it must derive up to 1 million euros. Now, if you go back to the Finance Act, the SEP order, the SEP order says you will be liable to tax in Nigeria if you make about over 25 million naira. And 25 million naira, I think, definitely should be about $30,000 of today. So will Nigeria make more if we follow our rule, or do we make less if we follow the OECD threshold? Definitely, it's going to be difficult. That means that a lot of companies are going to come and erode our virtual space, making money, and will not tax them. So, or they will say, wait until we determine what our global turnover is. If our global turnover meets up the threshold of amount A, which is 20 billion euro, and also we've made up to 10% profitability globally, and we've driven up to 1 million euro from the economy, that is when we pay tax. It's not favorable to us. So yeah, that's why you won't be surprised why Nigeria, Pakistan, Kenya, there are about 4 countries that say, you know what, we're not going to sign the statement, we're not going to agree, because it's not favorable to us. So there's that understanding that the international, I mean, the developed world, especially, are trying to come up with this. You know, you think that doing you a favor, they're not doing any favor. They want to make sure that they get as much as they want from your system. So the next one is due to the failure of the current international tax rule to address profit generated from digital businesses, some countries we've mentioned this before. So I think we've mentioned this, and we stated that this has led several countries to come up with their DST, digital service tax, on their own, just as we have in our own case. Now, can you move to the next slide, please? We're going to go to amount B of the same pillar 1. So what is amount B? This amount B is more like, it's closely related with transfer pricing issues. Companies that you know, that are in group, and it addresses the issue of in-country baseline marketing and distribution. That's what. So amount B is a separate form. Amount B is separate from amount A, and relates to the application of arm's length principle. It relates to application of arm's length principle. Of course, you know, in our last class of digital tax, arm's length, you continue to hear about arm's length. So companies that are related or that are in group, the issue of the tax authority will always suspect you that you can decide to have do underhand dealings in order to pay less tax and make more profit. Either you shift income from one country to the another, or you increase, for instance, you borrow from another group within a company, and the interest rate is too high. You know, if the interest rate is deductible, by the time you deduct it, you pay less tax. So the company is still having more money within themselves. Or you want to trade, you buy and sell and all that. So this particular rule relates to the application of arm's length principle to in-country baseline marketing and distribution activities. Amount B of Pillar 1 provides the framework for the simplified and streamlined applications of arm's length principle to in-country baseline marketing and distribution activities. It focuses on the need of low-capacity countries, which are most often related to unavailability of appropriate local market comparables through which arm's length prices could be established. In our last transfer pricing class, with this, the guest lecturer discussed about the unavailability of comparables, especially in developing countries, if you want to use COP, you know, in determining whether the price was the parties dealt at arm's length. So the purpose is to simplify transfer pricing rules for both tax authorities and multinational groups. Please, can you go to the next slide? So criteria for amount B to apply. Amount B applies to qualifying transactions of the following types: buy, sell, marketing, and distribution transactions, where the distributor purchases goods from one or more associated enterprises for wholesale distribution to unrelated parties. So when, for instance, company X and Y are related, company X bought goods at a wholesale price from company Y, a related company, and decide to sell it to an unrelated party. Then sale agencies and commissioners transactions, where the sale agent and commissioner contributes to one or more associated enterprises, wholesale distribution of goods to unrelated parties. So this rule tries to help the transfer pricing rules in resolving issues of related parties that perhaps they did not do in arm's length transactions. So move to the next page. Now, Pillar 2. This is a very interesting aspect of the rule and which you have to pay attention to. We're finished with Pillar 1. Now, under Pillar 2, Pillar 2 introduces what is known as global minimum tax, which is intended to address profit shifting to low tax jurisdiction in appropriate aggressive tax competition. So you will see, we're going to see both the pros and cons of this Pillar 2, but the Pillar 2 in general mainly wants a global minimum tax. There should be a global minimum tax. Somebody is going to argue, what about in the issues of tax competition? Different jurisdictions lower their tax rate in order to attract investment. By the time we have a global minimum tax where everybody in the world has minimum base, for instance, 15%, as we're going to see, everybody should tax, your global minimum tax should be 15%. Then that means that some countries, we're going to see what Ireland is complaining. Ireland has a 12.5% corporate tax rate and is complaining, oh, why should it be 15%? Because companies may want to come and do business in our country. So by the time you place the minimum rate to perhaps 15%, then there's going to be a problem. Then we're going to see under this rule that it does not really matter whether you change your tax rate to meet up to the global minimum tax. If you don't, you are going to see some rules. We're going to see income inclusive rule. We're going to see under tax payment rule. So income inclusive rule, we're going to see what it means. So that if you fail to top up your tax rate, then what it means is that the tax authority where the MNA is headquartered is going to top it up. Is going to make sure that that tax you did not tax in your jurisdiction, they'll collect it in the other country. So you can see somebody will say this is actually a gang up by developed countries to make sure that, you don't use tax competition is another way of fighting multinationals that go to tax havens or where you have low tax jurisdictions. So if you go to the low tax jurisdiction and they tax you maybe 5% instead of 15%, by the time your the parent company files its returns, what is your global annual income? What have you earned? How much did you earn from this country? How much did the country tax you? Okay, the country did not tax you up to the rate that we ought to have taxed. If it doesn't, then give us the money. So, and developing countries are going to complain, oh, if you do that, if this happens, that means we no longer have incentives to attract foreign direct investments. And the authorities, some other school of thought says, well, tax rate is one of the least things that companies will consider when they want to, set up business. But I seriously doubt it. Tax is very important. Most companies, when they want to take decisions where they're going to invest, where they're going to do business, one of the things they check is what are the tax implications for activities? How much are we going to get? What do you tax? At what rates? And what do you exempt? And companies always want to use this issue mismatch issues like comparing, if I'm in country A gives me a deduction for interest and company B does not charge tax dividend. That is mismatch. If you look at action 2 of the BEPS action, base relation and profit shifting action 2 of the OECD, is actually a mismatch. So how do you block the loopholes? Companies, of course, want to use this to make sure that they have more money in on their hands. So can you move to the next page, please? Next page, next slide. Okay, Pillar 2 conditions. Under Pillar 2, profits of multinational enterprises, which are currently not subject to tax, or subject to a rate that is lower than the global minimum tax, will be subject to a minimum tax rate of at least 15%. So let's say that the minimum tax rate is 15%. I think the agreed percentage, I was reading somewhere that agreed percentage among the OECD is 9%. But this one is suggesting that the minimum at which you will tax, your corporate tax rate should be 15%. Of course, in Nigeria, we have more than that, but I mean, but in terms of percentage, in terms of percentage, we have 0, 20, 30 for corporate tax rates in Nigeria. So the GMT is intended, the global minimum tax is intended to apply to multinationals with a consolidated group revenue of at least 750 million euro. Are you getting that? So the consolidated group revenue of a company that will be taxed under this will be at least 750 million euro. Some countries that rely on low tax rate to attract investment have expressed concerns about the GMT. Ireland has tax rate of 12.5%. The country proposed that a GMT should be 12.5%, same 12.5%. Some other countries, such as Hungary, are concerned that the GMT will affect their tax sovereignty. So the issue of tax sovereignty is the ability for the country to decide what to tax, when and how, and at what rate. So, and of course, tax sovereignty is one of the signs of the powers of a state to impose tax. So, but you can see that in the world of today, this issue of sovereignty is becoming a fluke. It's becoming a problem. It's becoming a fluke. So the world is now coming together to say, this is the percentage you are going to, the minimum. You can't go further than this. You can't go below this. If you go below this, the tax you do not tax, we're going to collect it. Please move to the next slide so we can see what income inclusive rule talks about. Under tax payment rules, what it's all about. Subject to tax rules, we're going to see this, which is a treaty-based rule and a treaty override provision. Can you move to the next slide, please? Okay, so you can now see income inclusive rule, IIR, and under tax payment rule. The income inclusive rule imposes current taxation on income of foreign controlled entity or foreign branch if that income was otherwise subject to an effective tax rate that is below a certain minimum tax rate. So for instance, if Nigeria signs up to this and it's agreed that the global minimum tax, corporate minimum tax is 15%, and you tax less than that, then what it means is that, we're going to see that under this income inclusive rules, that the country, we're going to see what the other country does if it is left for you to jack up your tax rate to meet the global tax minimum. If you refuse to tax, the country where the parent company is resident, the tax authority will ask how much did you make in country B or in country A? You made such and such amount, which is of course more than 750 million euro. How much were you taxed at what rate? You say I was taxed at 10%. So which means that the country has forgone 5%. That 5%, the tax authority will say, from the money you made from there, pay it to us. So that's another base erosion. When you don't comply, if you sign to this and you don't comply, this is what will happen. Or even when you don't even sign up, the law will still be applied. And that's why some countries are arguing this is going to cause a problem to us. It will developing countries, it's going to cause base erosion to us. And at the same time, it will deter companies like on the issue of tax competition. If I reduce my tax rate in order to attract foreign direct investment in my country, they may not come, because at the end of the day, they will still pay up those things that run away from their own home country. So the UTPR on the tax payment rule would either deny a deduction or impose a possible withholding tax on base eroding payments, unless that payment is subject to tax at or above specified minimum rates. So this is actually where, if for instance, we see I think the point I explained applies mainly to this, that using the under tax payment rule, what it means is that you underpaid. For instance, in Nigeria, the tax authority in your parent company will say you underpaid, therefore I'm going to add this. And because from certain distance, maybe deductions you want, I won't give it to you. Are you getting that? So these are what these rules are saying. The income inclusive rule is trying to include things that include more things in the income to make sure that they meet up the threshold. If you are taxing below the tax rate, I will include some of your distance into the tax net. Then when you pay under, definitely this normally happens in the home country of the parent company. Now move to the next slide. Next slide, please. Can you move to the next slide? It's like you're having an issue. So have you gotten to subject to tax rule? Can see that. Go to subject to tax rule.
Sir, you may have to continue. I'm having issues. It's not moving to the next.
Okay, no problem.
Sir.
The next one is subject to tax rule. As I said, that this subject to tax rule is a treaty override provision. It's meant to address issues when Pillar 2 includes what we call the subject to tax rule, STTR. The subject to tax rule is a treaty-based rule which may disallow treaty benefits available in existing tax treaties. So existing tax treaties, it said that the subject to tax rule disallows treaty benefits available in existing tax treaty where payment are not subject to a minimum tax rate available in a recipient country. So what it means is that if the treaty you have kind of taxes lower than the minimum, the STTR will override it so as to meet up the minimum. So the STT permits such jurisdiction, that is the market jurisdiction, to impose withholding tax at a minimum of 7.5% to 9% on interest, loyalty, and certain other payment-related entities where such payments are not subject to a minimum tax rate. So now, we are looking at the effect of global minimum tax on tax policy. What are the effects of global minimum tax on tax policy and incentives? That's what we're going to examine now. Okay. Now, a global corporate minimum tax will require countries to impose a rate that is not lower than GMT, the global minimum tax rate of 15% on corporate income. It effectively renders tax incentives redundant. We've discussed this. When you impose global minimum tax, then that means that tax competition or countries trying to reduce their tax rate to attract foreign direct investment may not be possible. This approach, which would remove countries' control of domestic corporate taxation, have been described as a significant incursion on national sovereignty by countries. Global minimum tax may result in tax revenues being exported to other jurisdictions. If a subsidiary's income tax rate in a particular country is below the minimum globally agreed tax rate, each parent company must pay a top-up tax on its proportionate shares of the income of the low tax subsidiary to the country where it is located. So what it means is that, as we say that, this global minimum tax looks at the global revenue realized by multinationals. Are you getting that? So, and as long as you make up to 750 million euro for the purpose of applying Pillar 2, and your global minimum tax, the minimum tax in your country is less than 15%. If you pay 10% here, what it means is that whether you sign the agreement or not, whether you support it or not, by the time the company files its return showing the overall global turnover and the profit made in each country, and also the taxes you paid in the other country, in your country, and the one you paid in your country is less than the globally agreed, the tax authority in the home country will force it to top it up by paying that differential, which ordinarily could have gone to the source country or the market jurisdiction. So I think this is another form of base erosion, but it is a base erosion that you can stop by, joining the bandwagon. So implementation of global minimum tax will put pressure on countries that have rates below the global minimum tax to increase their domestic rate, especially if not doing so, will effectively export tax revenues to the parent company's home country. Next slide, please. Effect of global minimum tax on tax policy and incentives. What developing countries or tax havens can do to amend their tax incentive regimes to benefit from the global minimum tax. Countries with income tax rate below the global minimum tax may have to increase their tax rates to meet up with the GMT rate or higher than that. Not doing so would definitely lead to tax exports, or what you could say, another form of base erosion. But I think the right time should be tax export, where the home country of the multinational that ratified the OECD GMT will now make sure that you pay the top-up tax. The parent company pays up the top-up tax. The top-up tax is that tax that will take care of that particular, the gap between the global minimum and what you actually tax. The global minimum says 15% and you tax 10%. That 5% you fail to collect, the home country tax authority will collect it from the parent company, from the profit that you made in your country. So in any case, it appears you don't have a choice, whether you sign or you don't sign. So tax incentives such as tax holidays, preferential rates, tax credits, investment allowance, income exemptions that lower or eliminate taxes paid on earnings should be amended in such a way to avoid that exploitation. I'll move to the next slide. The question now, what is Nigerian position in the OECD tax deal? We all know that Nigeria refuses to sign the OECD tax deal and saying that this does not favor us. The reason it does not favor us is look at our tax rate. The DST we have, the tax rate is anything from the threshold, anything from 25 million and above, and then you meet all the threshold in set order, we'll tax you. 25 million is not up to, may not be up to $32,000. And you are telling me, okay, for Pillar 1, it has to be 20 billion, not only 20 billion, 10% profitability, not only 10% profitability. I have to make up to 1 million euro from your country or 250,000 euro if you are a small economy. And to define the small economy, it has to be an economy that, that makes about only, I think, 40 billion euro. That has a 40 billion euro GDP. That's more than that. In 2022, our GDP was $477.39 billion. And it is projected that Nigeria is going to make $491.71 billion. So in any case, we're not a small jurisdiction, which means that we cannot, our threshold is not going to be that 250 million euro, but it's going to be 1 million euro that the company needs to make directly from our country before we can impose tax. So I think this is pure exploitation as far as I'm concerned. It's not meant for the interest of the developing country. It's not meant for the interest of Nigeria. If we're going to agree on this, that means they're going to come and make, and of course, knowing that companies definitely, they can plan, you know what, this is an oil company, we can make up to 999,000 euro. We'll stop there. So even if the global turnover is 200 billion, right? And they've made up to 10% profitability, then the question would be, did they make up to 1 million euro from your country? Oh, they stopped at 999,000 euro. Okay. You can tax me. Who is losing? Go back, the next slide, please. The next slide. Okay. Now, of course, we've discussed this. Go to the next slide. We'll discuss this one. Next slide. Next slide. Okay. We've discussed this too. Okay. Now, Nigerian position. I think the FIRS and OECD held a 2-day workshop in April to convince Nigeria on the need to accede to the 2-pillar solution and how to maximize the benefit, and also to sensitize our stakeholders. I think CBN, Joint Tax Board, State Board of Tax Authorities, and others attended. So they are OECD was trying to tell Nigeria why we have to agree to the 2-pillar solution. And the summary of it was that even if you're not going to agree with Pillar 1, you should agree with Pillar 2, because whether or not you like it, if you don't agree with Pillar 2, the global minimum tax will still apply. So the OECD G20, OECD Strategy 20 Inclusive Framework made the following recommendations to Nigeria. The recommendations were that Nigeria should, as a matter of urgency, commence engagement of stakeholders to draw up national strategy for the immediate streamlining of e-tax revenue, e-tax incentives, to avoid ceding e-tax base to other jurisdictions owing to the implementation of Pillar 2. 2, that there is need for Nigeria's continued participation in the rural development as a member of the inclusive framework to ensure that its interest and that of Africa are protected. Nigeria should explore the effective implementation of Pillar 2 rules for increased tax revenue generation to fund government programs, boost economy, and keep. So move to the next slide. Next slide, or is that the final? Move to the next slide, please. Okay. What Nigeria may do. Given that the threshold for taxing multinationals under Pillar 1 is significantly higher than the threshold under the SEP order, it is unlikely that Nigeria will sign up to Pillar 1 of the tax deal. As doing so, we'll see it lose out on tax revenues from numerous companies operating in the country's digital space. Nigeria is, however, likely to sign up on the Pillar 2. The reason is because if you don't sign up on the Pillar 2, whether you sign up or you do not sign up, the GMT will be applied, especially in the home country of the tax. So the decision may be informed by the need to shore up Nigeria's tax revenue, signing up to Pillar 2, and perhaps leaving out Pillar 1. Pillar 1 doesn't really favor us. In Pillar 2, there's nothing we can do. If you don't tax, they'll tax it the other side. So they'll tax the multinational on the other side. So we may have to sign up. These are more like the agreement Nigeria should try to agree with the OECD and see the one that favors us, the one that favor the provisions that favor us, and the one that do not favor us. So I'm sorry that tax generally is a technical subject. Some people may not follow, but I'm here for questions and answers, and that is the essence of this particular seminar. Mr. Steve, I've come to the end of the lectures. I've come to the end of lectures, Mr. Steve.
Sorry, Prof. I'm trying to also compile some of the questions. That's a very interesting and detailed explanation of the so-called OECD proposal that you may have been hearing in the press, or you might have read in the either the press or in the newspapers. You must have heard about it, why FRA did not, or Nigeria did not accede to the global minimum tax, to the global proposal, initiated by OECD. I mean, doctor explained this thing to the to the most minute detail. I mean, even if you don't understand everything, if you take this presentation and run through it, you are going to understand the rationale behind the failure of Nigeria to adopt the model initiated by OECD models. And we have some questions, and I'm going to look at them. Prof, just a minute. Okay, let's start with this. That should be the last question from anonymous attendee. Doctor, he said, do you see the OECD global minimum tax and the likely tax export making tax havens to rethink their position, or will the tax expert defeat the purpose for which they made their jurisdiction tax haven?
Can you come again?
Okay, do you see the OECD global minimum tax, and the likely tax export making tax haven to rethink their position? That's the first question. That's where the tax haven rethink their position.
Let me answer this before you go. Let me answer this before you go. Okay. Definitely, the essence of the global minimum tax is to make tax havens to have a rethink. You have the rethink because the global minimum tax rate is 15%, and we know that instead of using the word tax haven, let's say low tax jurisdiction.
Okay.
So let's use the word low tax jurisdiction. So the low tax jurisdiction is imposing, for instance, Ireland is complaining. Ireland imposes tax at the rate of 12.5%, which is less than 15%. And there are some other countries that may bring down their own 10 or 7. And the reason is that they want to attract foreign direct investment. They need investors to come in, because tax is one of the items that any business must consider before you take certain investment decisions. So now with the global minimum tax, what the superpowers, what the big guy, the global economies are trying to do is to discourage you, even the companies, from going, and also to discourage those low tax jurisdiction from imposing low taxes. Why? If you fail to move up your tax rate to meet with the global minimum, which is 15%, by the time the company reports its global turnover at the headquarters, at the home country, for instance, US, they'll look at how much do you make. Okay, you made up of 750 million euro, which is the minimum requirement for you to be subject to the minimum tax. How much did you pay and at what rate? I paid ABC amount at the rate of 10%. You know what the tax authority, you know what? Top up the remaining 5% from the profit you made there and give it to us. Since the country is not interested, since you don't want to collect the money, we'll collect it for you. So in any case, he's telling you, I'm going to go collect your money. If you don't collect your money, I'm going to collect it for you, and I will not send the money back to you because you have refused to tax at the minimum global tax rate. And that is what OECD was telling Nigeria when they came. You are going to lose out if you don't agree in some of these things, especially Pillar 2, because the global minimum tax, GMT, is under Pillar 2, not Pillar 1. You know, so that's the point.
I think you have also answered the second one. Maybe let me just ask you, say, will the tax export defeat the purpose for which they, I think the tax haven, made their jurisdiction tax haven?
Yeah, correct.
Okay, the next question is from Mojisola Ilupeju. Say, please, can we be intimated of the, I think it's not really a question. He said, can we be intimated on the upcoming topic before the lecture to enable us young lawyers to read ahead of the lecture to be able to relate to the topics? I think that has been made. Prof, Doctor, I think we share the topics ahead of the lecture over a week ago.
The topics were shared. If you look at the flyers have the topics.
Okay, yeah. So just go through the earlier flyer shared. You can see all the topics in this particular lecture series, and you can read up to that. Prepare ahead of the lecture. Tomorrow we'll be having a VAT, and then the following after tomorrow we have tax dispute. Now the next question from anonymous attendees: can a foreign company duly register with the CAC and having a base in Nigeria?
Can what?
It's can a foreign company
Yes.
duly register with the CAC and having a base in Nigeria be liable to pay PIT, that's personal income tax, for its foreign directors who do not draw any form of fees from the company? Not really your topic, but of course, you must.
Yeah, of course, the foreign directors, of course, we will know about the source principle. In personal income tax, there are two bases. One is residency. If you reside anywhere in Nigeria, the tax authority, and remember that Peter is not, for now, Peter has been taken out of FRS except for members of the police force, military, and maybe Nigerian ambassadors and all that, since the enactment of the FCT IRS Act in 2015. So FCT, before, FRS was collecting tax from residents of Abuja. Now, with the enactment of the FCT IRS Act 2015, there is now FCT IRS that collects, and a tax authority that collects taxes for the residents in Abuja. The state tax authorities collect taxes from people who reside in their places. So, but for non-resident, non-resident, FRS collects it. So, either you meet the residency requirement, either physically or by the 183-day rules deemed residency. If you're outside Nigeria, but you're earning income in Nigeria, you will pay tax. There's going to be a withholding tax. So it may not necessarily be, you are going to be a withholding tax on that particular earnings. And I think that is the final payment anyways, since you don't reside, doesn't reside. So there's going to be a withholding tax. for individuals.
Prof, I think the question borders where there is no payment from the company.
Is it?
Where there is no payment from the company to the directors. Maybe you address
where
that.
There's no payment.
Yes, no payment at all.
No, if there's no payment, what are you going to pay tax on?
Tax.
Taxes are paid on profit and earnings, so there'll be no tax.
Okay.
Sorry, I didn't get the question.
So once there is no payment, there will be no tax. And as Prof explained, if those directors are resident in Nigeria, for resident rule will apply, and they will pay tax if they have satisfied that criteria. So this question is from Mohammed Taha Omar. How can the developing countries strike a balance between adopting GMT and the need to attract investment by way of having lower taxes? That's a hard one. That's a hard one.
It's a very tough one. It's a very tough one, Mohammed. It's a very tough one because, as I explained, you have seen in the rule, if you reduce your tax rate, there's going to be a top-up tax that will be paid by the parent company in the home country to make up for the tax you left on tax. So you're actually kind of exporting your tax revenue to another country anytime you engage in low taxes. So it appears that these powerful countries want to force to ensure, because most of their companies are going to developing countries and other areas. It's a very difficult question. You know, I don't really, there's no way out, and that was what OECD told Nigeria. We have to apply the GMT, the global minimum tax. I think it's an favor. But then you have to go and reorganize your tax incentives and make sure that you don't leave anything untaxed. And honestly, I don't know how this will apply to, it's going to be very, very difficult. It's going to be difficult. Other than you'll be encouraged to develop your economy. They want you to develop your economy. So they want you to develop your economy. At one hand, they want you to develop your economy. At the other hand, they want you to be only export natural resources export. You export your natural resources, they will refine it and bring it back to you, which is what Africa has been doing all year round. They come in and make a lot of money in our country, and we get nothing. They come and say, well, you make $100 billion, and you are giving $1 million in aids, and you announce to the world you're giving developing countries, Africa, aids. And unfortunately, the leadership in the continent is not helping matters. The leadership is not helping matters. So that's one reason why every country in Africa, we have to sit up and develop our own economy, because they don't care. The developing one, they don't care.
Yeah, Bob, I think you are right. Well, maybe this question, let me phrase it so that you can understand it, because it's wrongly phrased. Say, can we have a session on the United Nations 77?
Can we have what?
A session on the United Nations 77. I think it should be the 77 Annual General Assembly. I don't know. On promotion of inclusive and effective tax cooperation. What is it?
I know United Nations has been doing a lot, has been engaging developing countries to hear their views and perspectives. If you look at the United Nations Tax Model Convention and look at the OECD Tax Model Convention, you will see that the United Nations Tax Model Convention appears to be more developing country friendly. But the point is that they are not as aggressive. OECD far ahead. OECD doing more. Are you getting that? So the United Nations has been engaging developing countries, even OECD itself. But most of the time, OECD engages us to ensure that, I don't know, somebody is going to question their I don't know, so we question whether they're actually for us or against us. So do you make this issue of transfer pricing? Companies, American companies or foreign companies, they want to hide money as much as possible. If they can send their money to low tax jurisdictions, they will do that. But these people are coming up with rules to make it difficult for them. Now, OECD came up with the automatic exchange of information, where they want us to share. You go to the bank, when you go to the bank to open an account, they'll ask you whether you're an American citizen. Why do you think they're doing that? Why do you think they're doing that? You know about the FATCA. America came up with FATCA. So that FATCA, I think foreign account something, just to ensure that Americans who reside outside the country, they are making certain amount of money, your bank will automatically report you to IRS, and IRS will wait for you. They can go after you.
Okay.
So some people actually denounce the American citizenship. Those who have lots of money, because in Nigeria here it's all about residency. In US is residency and nationality. So if you're an American citizen, whether you reside there or not, you have to pay. Anyway, sorry, this is outside my scope.
Okay, so what is Nigerian stand? Will Nigeria adopt that solution by the UN? I don't know.
OECD.
No. What is saying? If there's a platform initiated by the UN, will Nigeria adopt that stand? And of course, I think you have answered the question somehow. It may depend on whether they can actually enforce it. Don't you think so?
Well, the issue of enforcement, as we see here, like under Pillar 2, the company doesn't need to, the country, for instance, US, does not need to tell you, please move up your tax rate. All they want to say, oh, this is minimum of 15% GMT for every corporate tax rate. Whether you accede to the agreement or whether you sign or not is not their business. But as long as their company is doing business in your country, if you tax below that, that company will pay a top-up tax in the home country to make up for what you did not tax here. So you're exporting revenue to their countries. So it doesn't really matter whether you sign or you do not sign.
Yeah, I think this is not really a question. I don't know. Please do the. Okay, say you didn't get your explanation on Pillar 1 and Pillar 2. Is it something we can do, or we send the slide? I don't know, Prof. You want to explain it?
We're going to send the slide. We talked about that Pillar 1. The purpose of Pillar 1 is to ensure that companies, multinational companies or multinational enterprises that do not have physical presence in certain countries, but they do business digitally, online, virtually. I talked about Facebook. Facebook may not have office in Nigeria, but you're using Facebook. Some people are advertising in Facebook. You are using X or Twitter. Twitter may not have office here. Some people are placing advert and paying money. LinkedIn may not have office here. Some people may, okay, you want to have a premium account in LinkedIn. You are paying them in Naira currency every month. They're making money. Are you getting that? So the Pillar 1 wants them to pay tax in the market jurisdiction. Market jurisdiction are the jurisdictions where these multinational corporations do not have physical presence, or what we may term in international tax registrar as permanent establishment. We define what permanent establishment here under the OECD, Article 5 of the OECD and Article 5 of United Nations Convention, Model Tax Convention. All refers to that the company need to have physical presence in your country, either having an office, a branch, a representative. They are into a construction business and they've stayed there for like 1 year in OECD, 6 months from United Nations. That confers personal PE, permanent establishment, that gives you right to tax. But because internet has come, there's technology, that physical presence is no longer needed. And yet they're making money. So are you going to leave them? So Pillar 1 is saying you will tax, but on certain conditions. What are those conditions? First, that company must have a global turnover of above 20 billion euro. Not only that, it must make up to 10% profitability of that, whatever gross turnover they have. So if you use 20 billion, it's going to be, you must have a profit of 2 billion. It does not end there. The company must derive a minimum of 1 million euros from your country. This 1 million euro can only be exempted and reduced to 250,000 euro if you are a small economy. And what is a small economy? A small economy is an economy that has a GDP of less than 440 billion euro. Nigeria is not a small economy. If you look at the SEP order, what we have, for you to be taxed, the financial threshold is over 25 million naira, which is not up to $32,000 for today. And then you meet up, okay, you're advertising in Nigeria, you know, you're using NG or using our website and all those conditions and this and that, which is contained in the SEP order of 2020. Are you getting that? So, in summary, Pillar 1 taxes, activities of MMEs in market jurisdiction where they do not have physical presence. That's number one. Number two, the number two provides for global minimum tax, which we say, let's say 15%. It is saying, hey, country A or country B or country C, whatever you are, your corporate tax rate should not be less than 15%. It shouldn't be less than 15%. So if you have less than 15%, what it means is that if you collect 10% and leaving 5%, that 5% will be top. That 5% will be paid in the home jurisdiction. So whether you agree or you do not agree, you have to definitely pay the minimum tax. So you're exporting 5% to the country. So will you allow that, or you jack up your tax rates? Which is what OECD started in Nigeria, that we don't actually have a choice under Pillar 2. So for Pillar 1, well, you can negotiate. But Pillar 2, you don't have choice.
Yeah, I think the explanation provided by Doctor is very clear enough. And in any event, we are going to provide a slide after the lecture to enable people also use it to refresh their mind on the topic. There's this question by Bolan to me and Imashan. I'm not sure it's related to this, but I'm not asking. Coming home, why do we pay more on international flight from Nigeria than other African countries like Ghana? I don't know. Prof, if you can, we can move
I'm
ahead.
not the Nigerian government to... We all face the same problem. So I travel myself and I know what... In fact, the last time, this vacation, I traveled to Canada, and when I paid my ticket, I had to buy my ticket from Canada to come back here because it's cheaper for me to buy from there. I don't know why. And some people may move to go to Cotonou or go to Benin Republic or Ghana. I don't know if it is because of our tax rates. I do not know if it is because of the trap funds. The airlines are complaining that the money they make here, they don't actually get them out of the country. And I know that our president has directed that they should meet with the airlines to see how they take their money. So this is not my area. I don't really know, but these are just speculations. But what we know is that it is very expensive to buy flights in Nigeria. And I don't know why. Whether it is because of tax, whether it is because we don't allow airlines to take their money back to their home country. So it's actually cheaper to buy a ticket outside anyway. But the problem now is that some of the airlines who want to buy a ticket, if you're in Nigeria, they will insist from the server, they will know your location. So they may not even allow you to. I don't know. Maybe we can a relation outside. I don't know. It's just a problem. It's a problem that we should confront our governments. And some people are actually buying their ticket from Ghana. You know, from Ghana to Nigeria is like a local flight. Somebody in Nigeria, Ghana, you buy your flight and take off from Ghana and land through Ghana. That's a big problem. Thank you.
A big one, really. Adeni Thompson asked, is it possible for Nigeria to insist that multinationals must register a subsidiary in Nigeria, which will be subject to local tax?
Well, of course, as you know that under the CAMA, under the Company Allied Matters Act, there's a requirement for registration, except where those exemptions are granted. You all know that. We studied that. Everybody who has gone through the Nigerian law school, they taught us this. Either in the old CAMA or the current CAMA, there's a requirement to register in Nigeria for you to do business. But you know, under tax law, the taxman doesn't care whether you violated the law or not. We're interested only in the money. So if you look at the definition of foreign company under the CETA, I don't know, I think that's section 105 or thereabouts. He said that a Nigerian company is a company that is registered with the CAC. A foreign company is a company registered with any other country. So the taxman is not interested in whether you're registered or you're not registered. Even if you stole the money from somebody and it's your income, the taxman will collect the money. So you can't settle your problem with the prosecuting agencies, the attorney generals and EFCC or whatever can handle your matter. But for the taxman is only interested in the money, not interested in how you get the money.
Okay, from Gracia Bonire, Grace Abonere asked, what measures are being considered to ensure transparency and accountability in the implementation and monitoring of the global tax minimum rate?
Well, monitoring, implementing, as I said, that is left for Nigeria, that's left for your country to ensure that the FIRS in this case, because corporate taxation is the collection of corporate taxation is responsibility of FIRS. The state doesn't come in. So if, for instance, we agree, and definitely, of course, our tax rate, I think meets that, right? Yeah. I think anything less than 25 million, you don't pay tax, but you file your income tax, right? And anything between 25 to 100 million, you pay 20%. Then anything above 100 million, you pay 30%. And if you look at the threshold, the financial threshold, you'll find out that I don't think Nigeria has problem there when the financial threshold under Pillar 2 is 750 million euro. So 750 million is actually more than 100 million naira. And we're imposing 30%. So that's not a problem for Nigeria. But that's a problem for a country that is imposing less. So, but then the issue of enforcement and compliance issues is left for FIRS to monitor its agents, because the greatest problem we have in tax administration in Nigeria is corruption. Big time corruption, I can tell you that. So you will see some officers, they will look at, oh, this company is making, even when you've paid, they can rely on, say, oh, we are going to do a back duty more than 6 years. And they'll say, okay, because we suspect crime, or because you willfully fail to do this, on any of those exemptions, and then now they give you BOJ, based on judgment through assessment, without, having a proper ground. They can project, say, pay so and so billion. Then you come in, you find out that some officers get settled. I'm sorry to say this, but that's the fact. There's corruption in our tax authorities. So it's left for, especially the people, when you see some of these bad duties beyond 6 years, they look for something. So those involved in this thing. But anyway, well, that's not the subject of today. If we're going to talk about issues relating to bribery in the public service, is a different thing altogether.
Okay, doctor. We have another question from Mohammed Omar. Say, please, does the definition of non-resident company extends to a company duly exempted from registration under CAMA?
Yeah,
does the definition of, okay. So say, does the definition of NRC extend to such company?
We'll follow the interpretation of the CETA. I think under section 105. It said that a foreign company is a company registered with another country. For you to be a Nigerian company, it has to be registered with CAC. So if you don't register with CAC, you're a foreign company. Whether you're exempted from registration or not, you're a foreign company. By the definition of the CETA itself. Thank you, sir.
Okay. There is a follow-up question by anonymous attendee on the United Nations 77/244 Assembly. Say, will he meet the mandate he seeks to attain in terms of effectiveness?
The question is not clear enough.
It's not at all. It's not clear. I agree.
I can't let him tell us what that resolution is all about. I don't know what the resolution, and
yes,
I think we concentrated on OECD.
OECD for now, exactly.
Yes.
Okay, so for our start, Ayodele Yakubu, does it mean that when, for instance, 12.5% tax is charged, which is less than the 15% charge, does it mean that OECD will charge the remaining charges to complete 15%, or will it be charged, or will it charge the principal company another 15%? So I think,
no, the way
okay, you understand it. Okay, go ahead, sir.
Oh, you can, if you want, you can make.
No, I think what is asking that if, for instance, a company have charged 12.5%, will it be a top up, or are you going to charge another 15%?
There is going to be a top up, but that top up is not, OECD does not charge you. OECD is providing a framework for the world to have an agreement over taxation of activities of digital space and several other tax issues. So when we have a GMT, global minimum tax of 15%, and you have, for instance, Amazon, or let's say Twitter, or let's just call any company at all, and that company is based, for instance, in Spain, and the company is doing business in Nigeria, earning income digitally, or whatever, or doing any kind of business. And let's assume that we have less than 15%, the 12.5% that you talked about. Are you getting that? So there's going to be a top-up tax of 2.5%, not by OECD, but by Spain, the Spanish tax authority. In US, it is going to be the IRS that will tell the company how much. Of course, you meet the threshold of 750 million euro. Correct? Now, how much did you derive from that country? How much tax did you pay? At what rate? Oh, you paid at 12.5%. So what happened to the 2.5%? Pay it to us. It is a top-up tax. Since this country does not want to collect the money that is due to them, we will take it for them. That's it, sir.
Yeah, I think that's very clear. Okay, there is an anonymous attendee asking, what of situations where the company is only resident in Nigeria, for instance, and Nigeria has lower than the GMT rate?
Well, that one, there's no problem there, because I mean, since the company doesn't have any business in any other country, well, it will enjoy that. It will enjoy that. That's it.
Yeah, and I can even also ask, what about when two countries decided to evade the GMT rate by,
when what?
In a situation whereby two countries don't decide to evade the rate, you have the multinational in a non-signatory country, another one in a non-signatory country.
Yeah, for instance, if the two countries, for instance, in the statement, the October 2021 statement or agreement, we call it, Kenya failed to accede to it, Pakistan failed to accede to it. Yeah. So we can have a bilateral agreement with those countries, and we'll implement that. So, but the question is, OECD is aggressively fighting to ensure that a lot of countries, subscribe to the agreement, so that you have less countries. So, but if you have more countries that don't subscribe to it, you can deal with yourself. You know, we have the BRICS. So Russia can decide to deal with India. Can decide to deal with India. South Africa can decide to deal with Brazil and all that. So that we don't have the world controlled by one particular force. Let there be alternative. People are looking for alternative.
I think so. I think so. But unfortunately, most developing countries here, as well as in Africa, have acceded to the OECD's proposal. And I'm rather surprised. I don't know. Probably they were coerced, or because of other benefits they could get from the OECD member country, they quickly acceded to it.
I must tell you one of the lessons I learned when I was doing my program, the last time I went to US to do a program at ELSO. The tax professor told me, said that one of the problems that he's surprised that African representatives, they don't read the agreements. that most of the things they sign, they don't read them. They don't even know what they're signing.
It's true.
They'll just go ahead and sign it.
I agree.
You send representative people who don't know the implications of what they're signing to protect the interests of. That's why I'm very happy that in this case, Nigeria refused. But as you said, other countries in Africa, they just signed it. They don't know what they're signing.
Yeah.
Okay.
There's another question from an anonymous attendee. Say, where an international company derives profit from Nigeria and withholding tax is charged on the income in Nigeria, how does the foreign company treat the deductions where there is no DTT between the foreign company, between the foreign country? It should be the country where the foreign company is resident and Nigeria, just so it can make sense.
I don't understand. Is he saying that the country where the foreign company reside does not agree, does not accede to the GMT?
There's no. This has nothing to do with the DMT. This is for DTT. He said where an international company derive profit from Nigeria and withholding tax is charged on the income in Nigeria, how does the foreign company treat the deduction where there is no DTT between the foreign country and Nigeria?
Well, for first, DTT is generally meant to reduce tax and to ensure there's no double taxation. That's why the tax rate in DTT is always lower. So in this case, I don't understand why what DTT has to do. If there's no DTT between the country where the foreign company reside with Nigeria, Nigeria will tax you at the normal rate.
Yeah.
The DTT rate is always lower than the normal rate when we ordinarily charge, or any other country ordinarily charge. And some of the benefits, like, for instance, credit, some of the benefits that you would derive in recouping the taxes when you are taxing two different jurisdictions. The essence of double tax treaty is to ensure you don't pay tax twice at both countries. And generally, the rates are always at a reduced rate. So if your country doesn't have DTT with Nigeria, with any country, it's on reciprocity. So if there's no DTT, we'll tax you on the normal rate.
Yeah.
As we tax our domestic country. And if you go back on your country tax it, that's your business.
Yeah, it's true.
So, but if I should reframe the question the other way to bring it with what we're discussing, the question I would ask is, what about if there is a GMT and the DTT rate is less than the GMT? What happens? In that case, the STT subject to tax rule will apply, which overrides the DTT, and the GMT rate will apply if you accede to it. Otherwise, if you follow the DTT, by the time you go to parent company, they use top-up tax to pay for the difference. That means you're exporting revenue.
Yeah. Yeah, what doctor is just saying that if there's no DTT between Nigeria and the country of resident of the foreign the deduction made in Nigeria will not be reckoned with. They will be double. There will be incident of double taxation, and of course that's the essence of having a DTT. So without DTT, you cannot enjoy it. The country will not enjoy it. Of course, that's why many countries are trying to expand their DTT base. Prof, there's also another question from the same anonymous attendee. Can a Nigerian company validly contract with a foreign company not to deduct tax from the income of the foreigner derived from Nigeria? In this case, which party bears the liability? So that I don't understand. I don't know. Can a Nigerian company validly contract with a foreign company not to deduct tax from the income of the foreign?
I think there's an amendment that it is not part of what I'm supposed to have here, like where you have a tax clause, that allows you to bear the tax burden. Yeah. There's a case on that. I think it's that Shell or Mobile, but the current amendment in the Finance Act of 2023 made a mess of it. So, like, if you agree, that's your business. That is your business. So the tax authority would definitely tax. You pay the tax. So you have no right to say this particular activity I'm entering into with a foreign company, they will not pay tax that Nigeria should pay. You bear the burden. you bear the burden. But however, companies, there's ways where the kind of you can factor in the tax into whatever that is going to be paid to you to ensure that the profit you make, you eventually make it and still pay the tax. But to avoid it and to give away, you have no right, no company has the right to decide not to pay Nigerian tax. The tax authority will go after you. You have to pay. Thank you.
Okay, there's, this particular question from Inikbi Okutachi. Say, will this have an impact on the digital business if they open branches in the free trade zone? I think maybe I don't know.
Of course, the free trade zone is not one of the is not exempted. So that's why we're saying that there's going to be a real shake-up kind of within the tax, because a free trade zone or free trade area, one of those incentives to encourage countries to come in. So these are the things that our country, Nigeria, should negotiate with them. Other countries should negotiate, because the essence of free trade zone is to help in attracting foreign companies to come out and operate outside the custom area. So in any case that they will not pay tax, even though the tax law require filing returns to see what you are doing and to ensure that you're actually doing what you said you should be doing within the free trade zone. So I strongly believe that I have not seen where it is discussed that such particular incentive will be exempted, so that the company will not pay the top-up tax by the time it goes back to its own return. And remember that this particular thing is still a work in progress. Still a work in progress. So enforcement hasn't started.
Yeah.
Thank you.
You said there's a particular question from one of I can't see the name clearly. MF. Say, is there any law precluding medical facilities and hospitals from paying taxes? Say he's aware that they don't pay VAT. Does it mean that they are precluded from all taxes?
I know that medical practitioners who have their clinics, they pay tax. They pay tax. I've assisted some to navigate through the tax issues. The payment of tax is based on, are you making money? Do you make profit? If you do, you pay tax. If you are running a non-profit organization and it falls within those exempted, ecclesiastical organizations, and remember, even if it is an ecclesiastical organization, this is actually the area of my topic today anyway. Sometimes you go to the church, if you go to Holy Ghost Cathedral in Enugu, you see where they're selling books, holy books and all that. You go to Father Mbaka, go to this, they're selling a lot of things. And those things, economic activities. If the economic activity, when they make money, wouldn't they pay? So even under the exemptions, either within SITA or PITA, you have to restrict yourself within those areas, the particular defined zone. So the fact you are running a hospital, are you not making money don't you charge, when people come for you to render medical services, don't you charge them money? Are you doing it pro bono? Are you doing it free of time? You're making money, so you should pay tax.
I think, Prof, that you are right. It's only maybe consumption tax, those that impart on the patients that are tax exempt, VAT. But of course, if they earn income, they will pay their
the VAT has medicals or even purchase of medical equipment
facilities.
There are services or goods that are exempted from the VAT.
Yes, sir.
If you get the VAT Act, you will see those exempted, and some even the zero-rated ones.
Yeah.
So, but that's what we're discussing today. So on VAT, yes. Income tax, no. Still get tax, no.
I think we are nearing the 4 p.m., but maybe we just take one more question. I don't know. What are the reporting obligations under the OECD for foreign multinational companies for purpose of tax?
Well, the reporting obligation is, for instance, under the transfer pricing rules, right? Companies prepare their global returns in their home country and show how much they've earned in other. So this is part of the transfer pricing rules. And most of these transfer pricing were adopted by most countries. So there's that reporting obligations. We want to see what you earned, what you have in US. Want to see what, and now OECD is in a mission trying to get every country subscribed to automatic exchange of information. There's exchange of information on request. The automatic exchange of information is whereby the tax authorities are going to gather information about what you have earned in our country, the tax you filed here, and we exchange it so that everything will be in the open. Under the transfer pricing rule, in your parent company, you have to show your global what your reports in all the countries you've done business. How much do you earn, and all that. So it's already there in the rules. It is to help stop from companies cheating other countries, because a lot of companies go to tax havens or go to low tax jurisdictions to ensure that they evade taxation. Thank you.
Okay, Prof, can we still? This is already 1 minute past 4. I don't know.
Okay.
We have some few questions.
Let's take one question, then we can call it a day.
Okay, there's this question from Hajar Agaba Magashi. There are 2 questions in one, maybe. I think they are related. Is the OECD stroke G20 proposal a multilateral tax treaty? If not, what is the legal status of the proposal? Hajara Agaba Magashi.
Okay, the proposal is multilateral in nature. Multilateral treaty or multilateral agreement is when there are more than 2 countries. You have more countries, unlike bilateral treaties where country A and country B enters into bilateral treaties. Most of the double tax treaties are bilateral in nature, but the proposal is multilateral. There are about 136 countries that are already joining to the proposal. It is still developing, so it is multilateral. On the legal part of it, yes, if you enter into a convention, in any multilateral treaty, it is enforceable. Within the it is expected that you as a country should obey whatever you sign to. Despite that, different countries may have different ways of ratification of treaties. Other countries may have, okay, once you enter, it's applicable in our country. But in Nigeria, no. You have to present it before the National Assembly, so that the provisions of Section 12 of the Constitution, which requires that the National Assembly should ratify and pass to third majority, approving the treaty. And that is why I think the tax treaty to have in Nigeria is about 15 or thereabout. We don't have much. So in Nigeria, if it doesn't pass the Section 12 requirement, there's going to be an opposition in the court for it to be enforced. Because at that point in time, it is still not part of our laws. I think the case of Ghani and Abacha, right, is one of the cases that they cite and talk about the hierarchy of laws, the Constitution, treaties entered into, then the domestic laws and all that. So if it is not a treaty signed by Nigeria, that's a big problem. If Nigeria signs that, meeting the domestic requirement is another. However, if, for instance, you are sued somewhere else outside the country, that's a different ballgame altogether, because it is an international obligation under the laws of treaties. I mean, certain convention, although that's why ICSID convention is a different case. In ICSID, if you're part of the ICSID convention, you can't, of course, in Nigeria, I think we have an act in Nigeria that actually domesticated the ICSID convention. So that's I think this helps anyway. So
well, I think that's much we can we still take more? I think we've tried.
Okay.
This is over 2 hours of intensive and detailed lecture on the digital taxation. I mean, we thank all the attendees and the participants in this space, and we are still continuing tomorrow and next tomorrow. Tomorrow is going to be on value added tax. Why Wednesday we're going to have a session on tax dispute resolution. Thank you very much. Dean, do you have any word?
Well, thank you, everyone.
You have a double responsibility today.
Thank you everyone for your participation. We encourage you to continue. We still have 2 more days to go. Tomorrow there's going to be a tax, I think on VAT, right?
Yes.
We'll have
going to be on VAT.
On VAT, and our brother here, Steve, is going to be the guest lecturer tomorrow. And after that, of course, VAT is a very hot topic in Nigeria. I expect that we'll have more participants because it is good you know about that. The FRS is not interested. Ignorance of the law is no excuse. Come tomorrow and see, to hear from the authority. Then the next day is going to be on recent issues relating to tax appeal tribunal. So a judge of the Federal High Court, Dr. Nnamdi Dimba, Honorable Justice Nnamdi Dimba will be here, and a panelist, the chairman of a Lagos Tax Appeal Tribunal. You can remind me the name, Steve?
Yeah, Moshood Olariwaju Lazisi.
Okay, Moshood Olariwaju. These are authorities. It's going to be very interesting on Wednesday. So we'll draw the curtain close on Wednesday, and we'll thank those who have been participating on this. May God bless you all. Thank you.
Thank you.
Yeah.